Hello everyone, welcome to Mastermind. Today let us learn more concepts on economic by solving few more multiple choice questions. These are very important and could be asked in any examination that is based on multiple choice questions. So please consider these as very important part of the syllabus and try to solve this before watching the video for solutions, and also please note down these points as these points will be handy just a day before the examination. Let us get started. First question: which of the following are quantitative tools of monetary policy? Liquidity adjustment facility, open market operations, consumer credit regulation, statutory liquidity ratio. So here A, B, and D form quantitative tools of monetary policy. Therefore, here the right option is option 3, A, B, and D only. So there are two types of monetary policy instruments. The one is quantitative and the other is quantitative as well as qualitative. So what are quantitative instruments? Quantitative instruments of monetary policy are those instruments or the measures that affect the overall supply of money, overall supply of money or credit, overall supply of money or credit in the economy. But there's one more thing, that the quantitative instruments can be measured. Like if the repo rate is increased by zero point 0.5 basis points, then 0.5 is something that could be measured. So quantitative, as the name it indicates, it is measured. So quantitative instruments of monetary policy are the measures that affect the overall supply of money or credit in the economy. Please remember. While qualitative instruments of monetary policy, as opposed to quantitative instruments, affect the flow and direction of credit to particular sectors. To particular sectors. Qualitative deals with particular sectors in a positive or negative manner. So quantitative deals with entire economy, while qualitative deals only with the particular sectors of the economy. So which are the quantitative tools of monetary policy? Bank rate, open market operations, cash reserve ratio CRR, statutory liquidity ratio CSLR. Statutory liquidity ratio means SLR. And then liquidity adjustment facility. If you have watched the earlier video, you will know that liquidity adjustment facility has repo rate and reverse repo rate. So these things come under quantitative monetary policy instruments. So what are qualitative then? Qualitative examples are margin requirements, moral suasion, moral suasion, moral suasion, and then selective credit control, direct action, rationing of credit. Direct action and then rationing of credit are some of the qualitative tools used to control the credit. Therefore, selective credit control or consumer credit regulation come under qualitative tools of monetary policy. Second question says, consider the following statements related to Operation Twist. It is a fiscal policy tool. Under Operation Twist, the RBI buys long-term bonds of the government and at the same time sells short-term securities of the government. Here, the right option is option 2, B only. Operation Twist is a monetary policy tool. It is a monetary policy tool. So what is this Operation Twist? Operation Twist is when the central bank, in the case of India, central bank is RBI. When the central bank uses the proceeds from the sale of short-term securities to buy long-term government bonds, long-term bonds of the government debt papers, leading to easing of interest rates on the long-term paper. So this results in easing of interest rates. This Operation Twist first appeared in the year 1961 as a way to strengthen the US dollar and stimulate cash flow into the economy. So, and you'll also have to remember this Operation Twist stimulates the cash flow. It stimulates the cash flow into the economy. In the year 2019 as well as 2020, as well as 2020, the Reserve Bank of India conducted its version of Operation Twist through simultaneous purchase and sale of government securities under open market operations. So open market operations means it's buying and selling of the securities. Government securities. Let us look at the third question now. To fight inflation, which of the following steps can be taken? Expansionary policy, RBI sells G-Sec to public, CRR and SLR are increased. So here the right option is option 3, B and C only. So first of all, let us see what is inflation. Inflation is nothing but general rise in the price level of an economy over a period of time. Usually it is considered with respect to a base year. So inflation means it is a general rise in the price level in an economy. Inflation in India is measured by Ministry of Statistics and Program Implementation, that is MOSPI. The most commonly used indexes to measure it are CPI, Consumer Price Index, and WPI, Wholesale Price Index. The measures to control inflation's main goal is to reduce the inflow of cash into the economy of the market's liquidity. So, when inflation increases, please remember, when inflation increases, money supply should decrease. When inflation increases, money supply should decrease. Only then inflation can be controlled. Therefore, whenever we have to fight with inflation, then we'll have to make sure that the money supply in the economy decreases. So when it decreases, inflation can be brought under control. So to fight with inflation, contractionary policy is followed. Contractionary monetary policy is followed. What is this contractionary monetary policy? It is focused on decreasing the money supply in the economy. In other words, contracting the economy. This is also known as tight monetary policy. Tight monetary policy, and a contractionary monetary policy is implemented by increasing key interest rates, thus reducing market liquidity. When RBI sells government securities to public, when the government sells the government securities to public, then public will give money in return to buy. Therefore, with public, money will be less. That is, there will be less money in the public hands. Therefore, the liquidity decreases, and as liquidity decreases, inflation can be tackled. If RBI increases cash reserve ratio and statutory liquidity ratios, then banks will correspondingly increase the interest rates. As the banks increase the interest rates, borrowings suffer. Borrowings suffer, and as the borrowings suffer, there will be reduced money supply in the economy, which controls the inflation. Therefore, the right option here is option 3, B and C only. Fourth question says, consider the following actions by the government: cutting the tax rates, increasing the government spending, abolition of subsidies. In the context of economic recession, which of the above actions can be considered a part of the fiscal stimulus package? So here the right option is option 1, A and B only. Fiscal stimulus means it is a government controlled measure. It is a government controlled measure that involves changing government spending and taxation to revive the economy. So the government uses this fiscal stimulus package to influence overall supply and demand, overall supply as well as demand in the economy. So an increase in the public spending, increase in the government spending or public spending, or a reduction or cutting the tax rates might be done by a government in order to encourage and support economic growth. So as taxes are reduced, or as the spending is increased, as the taxes are reduced and or as the spending increases, this results in expansion of economy, or economic activities get a boost. However, this abolition of subsidies is a part of rationalizing the expenditure side of the government. That is, it reduces unnecessary expenditure from the government side. So this is more considered as a fiscal consolidation. This is fiscal consolidation. That is, this is rationalizing the expenditure side of the government. This is not fiscal stimulus. Abolition of subsidies do not provide an impetus to economic growth, but this provides fiscal consolidation, or in other words, it ensures fiscal discipline. Now, consider the last question for the day. Consider the following statements about the Monetary Policy Committee. It is established under RBI Act 1934. Governor of the RBI is the ex officio chairperson of the committee. So here, both the statements are correct. Both the statements are correct. Therefore, the right option is option 3, both A and B. So, Monetary Policy Committee, as we have discussed in the earlier video, it is a government constituted body of the RBI, which is responsible for framing the monetary policy of the country using the tools like reverse repo rate, bank rates, etc. Urjit Patel Committee, please remember Patel Urjit Patel Committee was the first committee which recommended for the formation of Monetary Policy Committee, and the prime objective of this committee is to determine the policy interest rate required to achieve the inflation target. RBI Act 1934 empowers the RBI to make monetary policy decisions. Therefore, it is established under this act. The meetings of the Monetary Policy Committee should be held at least 4 times a year, and it publishes its decisions after each such meeting. So, the Monetary Policy Committee, as we have discussed in the earlier video, consists of 6 members, 3 officials of the Reserve Bank of India, and 3 external members nominated by the central government. The governor of the RBI is the ex officio chairperson of the committee, and each member of this committee has a tenure of 4 years. Decisions are usually taken by the majority, with the governor having the casting vote in case of a tie. MPC decisions are taken by voting, where a simple majority is necessary for a decision to be passed. So this is all about important MCQs based on economy in this video. Please try to note down these points and revise these points as and when possible so that you get a hold on these concepts. Thank you.